This is Nightly Business Report with Sue Herrera and Bill Griffin.
Roadmap. The U.S. and China are plotting out their trade talks, and investors breathe a sigh of relief.
Critical shortage, a life-saving medicine that's becoming harder to get at a time when demand usually spikes.
Sticker shock. Why full-size pickup trucks now come with a supersized price tag. Those stories and much more tonight on Nightly Business Report for this Friday, August the 17th.
Good evening, everyone, and welcome. So just how important is trade with China to the market? Today, we learned that it is key. Stocks were flat for the most of the morning, but all that changed when a report surfaced that President Trump and President Xi hope to discuss trade in November. And there's currently a plan being worked on ahead of mid-level talks next week. That lifted the Dow by 110 points to 25,669. The Nasdaq and the S&P 500 both rose by 9. The major indexes were mixed for the week.
Now, going into those trade talks, the White House has been playing up what it calls China's economic decline. But some say a closer look at the numbers show things may not be all that bad. Bob Pisani has more.
China's stock market is in terrible shape, but it may not reflect the state of the Chinese economy. President Trump's National Economic Council chief, Larry Kudlow, raised eyebrows yesterday when he said in a meeting with President Trump that China's economy, quote, looks terrible. But is it really? Most estimates for China's GDP growth remain near 6.5%. That doesn't mean there aren't concerns, of course. New U.S. tariffs on China are making it more costly for companies there to operate, and China's central bank has recently been pumping money into the economy. But many experts say the 25% drop in the Shanghai exchange from its January high does not really reflect a dramatic deterioration in the Chinese economy. In fact, it tells us very little, and it doesn't necessarily play anywhere near as dominant a role in the lives of its citizens as the U.S. equity market does. The Shanghai market staged a huge rally from 2014 to 2015. It more than doubled in value, but again it collapsed and is trading 45% lower than 2015. According to one analyst, this has had very little impact on consumer spending or business sentiment. There's a bit of a disconnect here. The fact that China's stock market does not necessarily reflect the state of the Chinese economy has some very important policy implications. So, for example, further declines in Chinese equities may not push the country's leaders into an unfavorable trade deal with the United States. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
There is also progress being made on trade with Mexico. A top White House economic advisor said that Washington is, quote, very, very close to coming to an agreement. Mexico's economy minister made similar comments today, saying he hopes to resolve issues surrounding the renegotiation of NAFTA by the middle of next week.
Now, despite the positive news on trade today, there are other issues the market has to contend with, and that's one of the reasons why Pimco is talking about the potential risk of recession. Mihir Wara is the Chief Investment Officer of Asset Allocation at Pimco. He joins us now with more on that. Mihir, welcome. Thanks for joining us tonight.
It's my pleasure.
You're waving a kind of a yellow flag in this regard. Let's go through some of the indicators that you're watching very carefully. And the first one is inflation. Things are picking up, aren't they?
Yeah, we're starting to see inflation pick up. Nothing dramatic. Inflation is going to end this year around 2.5%, up from 1.5% last year. But inflation is a lagging indicator. And the key thing is where we are today, if you're wrong about the 2.5%, all the risks are to the upside, whether it's from a trade war, whether it's from the $1 trillion deficit that we're running at a 4% unemployment rate, or whether it's from oil prices spiking. So it is one of the things we're watching.
Which also leads you to being concerned about the correlation between stocks and bonds and the inability for the average investor to perhaps diversify.
Right. So bonds are a great diversifier in a plain vanilla recession. If we have a plain vanilla recession, 10-year treasuries will be the best asset to own. However, along the way, as inflation starts to rise, you may find the stock, bonds may not be such a great diversifier versus stocks. So we look at other things like gold, for example, to help you in your portfolio.
It's a very technical term, dispersion, that you're watching, but basically it's where investors basically get their best returns. And it's been concentrated for so long in equities, but you're starting to see it disperse into other areas too, right?
That's right. You're going to see more volatility. You're going to see more winners and losers. For example, for the last several years, when the economy was growing strongly and the Fed was not hiking rates, was suppressing volatility, you could buy almost anything and it would go up in price. And we think this is the time to start being more careful. One of the things we particularly like are short-dated corporate bonds. At 3.5% yields, these are giving you decent returns without taking a lot of risk.
All right, Mihir, thank you. Mihir Wara, waving the yellow flag on recession from Pimco tonight. Thanks for joining us.
Thanks.
Well, along those lines, consumer sentiment hit its lowest level since September. That's according to the University of Michigan's index. Consumers are concerned about rising prices. The decline in sentiment was primarily seen among less affluent households.
President Trump has asked the SEC to study the possibility of requiring publicly traded companies to release their earnings results only twice a year instead of the current norm of 4 times a year. The president said the idea came up during a meeting he recently had with corporate leaders.
This took place when I had, as you know, the world's top executives, among the world's top executives, and the head of Pepsi-Cola, a great woman who is now retiring. She said, because I asked, what could we do to make it even better? And she said, 2 times a year reporting, not quarterly. And I thought of it, and it made sense to me, because, we are not thinking far enough out. We've been accused of that for a long time, this country. So we're looking at that very, very seriously. We're looking at twice a year instead of 4 times a year.
And in fact, Pepsi's outgoing CEO, Indra Nooyi, confirmed that report. She says the idea of allowing companies to focus on their longer-term strategy is also being discussed among Business Roundtable members. And late today, the SEC said, in fact, it does continue to study public company reporting requirements, including the frequency of those reports.
Tesla's CEO, Elon Musk, gave an interview to the New York Times, which is being described as emotional and off-kilter. He called the past year, quote, excruciating and the most difficult and painful of his career. Details of his struggles sent the stock down nearly 9% today. As you know, things intensified for Mr. Musk last week when he tweeted that he had the funding to take the company private. As we reported last night, the SEC is reportedly investigating whether the tweet was intended to hurt short sellers.
Short sellers are sometimes portrayed as the bad guys on Wall Street. They're rooting for company stocks to go down. But shorting is a legitimate investment strategy. Dominic Chu explains how it works.
Buy low, sell high. That simple market cliche captures the essence of investing. Purchase an asset, like a stock today, at a certain price, and if it goes up in value, sell it for a higher price at a profit. For most investors, if that formula works, you make money. If it goes down in value, you lose. But what if you could make money by simply reversing the steps? Sell high, then buy low. That's the basic framework for a short sale. Here's how it works. Let's say ZYX Corporation shares are trading at $100 each. But a trader believes that the shares are only worth around $90 given its business prospects. That trader then goes out on the hunt for anyone who owns shares of the company who's willing to let her borrow them with a promise to return them at some point in the future. Once the shares have been borrowed, the trader sells them at the current $100 price and pockets the money. If she's right and shares fall to $90 in the future, she then takes her money, buys the stock at $90, and returns those shares to the original owner. Sell high, get $100, buy low, spend $90, keep the $10 profit. But the flip side is, if the shares go up in value, the trader loses, and theoretically, the potential loss is unlimited in a short sale transaction, which is why only seasoned traders use the strategy. The actual transaction and logistics of a short sale are more complicated, but you get the picture. For Nightly Business Report, I'm Dominic Chu.
And right now, the 5 most shorted stocks in the S&P 500 are Under Armour, Discovery Communications, Mattel, Advanced Micro Devices, and Kohl's.
So let's turn now to Aswath Damodaran for more on short selling and the role that it plays in the stock market. He's a professor of finance at NYU's Stern School of Business. Welcome. It's nice to have you here.
Glad to be here.
So talk to me about the fact that you think that the short seller in the market is part of an overall healthy environment for the market, correct?
Yeah, I've never understood why people think of being long as moral and being short as immoral. There's something wrong with that picture to me. If you believe that something's going to go up and you want to buy the stock and hold it, all the more power to you. By the same rationale, if you think something is overpriced, I think you should be able to bet against that investment. I think it's healthy for the market to have both optimists and pessimists in the room.
We showed the 5 companies that have the highest, what's called short interest, the highest number of shares that have been shorted by short sellers. Are those necessarily companies that investors should avoid if they want the stock to go up?
No, I think they're just companies where there's a lot of disagreement about the future. I mean, some of the most successful companies in the world have been short targets at some point in time, including the FANG stocks. When you look at Facebook and Amazon and Netflix and Google, at some point in time, each of these companies has been targeted. They've managed to succeed and become incredible companies in spite of the shorting. So I've never believed that just because people are down on a stock, that you shouldn't invest in it.
You make the point that it's not the short selling in itself that's damaging to the company, but rather it's the reaction of management to those short sellers.
I think managers overreact to both short sellers and people who are long on the stock. They manage the price instead of managing the value of the company. I think any management that focuses on what investors are doing in the marketplace is doing the wrong thing. I think management needs to focus on what they need to do within the company and let the market take care of itself.
I'm tempted to ask, there are going to be people out there watching saying, maybe I should try this. Should the average investor think about short selling? What do you say?
There are 2 constraints you got to keep in mind. The first is when you sell short, your time horizon is not often under your control. I mean, I'll give you an example. You buy something, you can hold and hold as long as you can hold on. But when you sell short, your time horizon might not be under your control. The second is when you go out there and try to get those shares to return them, they might not be around. That's a short squeeze. If you walk in with open eyes, there's nothing wrong with short selling. But if you think this is an easy game to play, you're in the wrong game.
On that note, Aswath Damodaran, thank you so much for joining us. He is with NYU's Stern School of Business. Bill?
All right, time to take a look at some of today's upgrades and downgrades. Now, we have a downgrade for Walmart tonight, but it's not as bad as it sounds. Raymond James is cutting its rating on the stock to outperform from strong buy. The analyst says that Walmart's purchase of Flipkart will weigh on operating earnings. Flipkart is India's largest e-commerce company. Price target now on Walmart, 107. That stock fell a fraction today to 97.85. Dean Foods was downgraded to underweight from neutral at J.P. Morgan. The analyst cites reduced confidence in that company's ability to meet expectations. Price target reduced to $6. That stock fell about 5% to $8.20.
Yum China's rating was downgraded to perform from outperform at Oppenheimer. The analyst cites headwinds at its KFC brand. He also says same-store sales improvement could take several quarters. The stock fell 1% to $34.86. DSW's rating was cut to negative from neutral at Susquehanna. The analyst cites margin pressure from its new loyalty program and higher costs. The price target is $22. The stock fell almost 5% to $26.49.
Still ahead, farmers are spending money on machinery despite trade concerns, and that's good news for Deere. With many farmers around the country growing concerned about rising tariffs, many Wall Street analysts expected that would negatively affect Deere's latest results. But as it turns out, the farm equipment maker said today that demand is still strong, and that helped lift the stock. Morgan Brennan digs deeper into Deere's report.
Despite trade tensions, John Deere saying replacement demand for big agricultural equipment is boosting sales, and expects that, at least for now, to continue. On a conference call with analysts, Chief Financial Officer Raj Kalathur gave an upbeat outlook.
Global demand for grains continues to grow consistently even as trade flow patterns readjust to accommodate various policy changes. Overall, we are encouraged by the outlook for the rest of 2018 and the early interest for our latest technology to come in model year 19.
It was enough to turn the stock around after shares of the farm and construction equipment makers started the day lower on an earnings miss. Total equipment sales rose by more than 35%, but profit fell short of expectations due to higher costs for material, think steel, and freight. Deere also stuck with its prior full-year guidance, which had analysts wondering whether, and after years of slumping demand, the company's recent recovery could yield higher equipment prices.
If you're at the peak of the cycle or you're in the sweet spot of demand and you can't get pricing power at this point in the cycle, then you're never going to get it, and that's the concern that investors have in these cyclical stocks.
Deere shares are down about 17% over the past 6 months, seen as an at-risk from the trade tensions between the U.S. and China. The concern? The Chinese tariffs on U.S. crops like soybeans could mean less demand for the tractors and combines that Deere makes. But the company's also been dinged by higher steel prices that tariffs on that metal have helped push up. Still, the optimistic guidance helped buoy shares, sending them higher as demand runs like, well, a deer. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
Campbell's Soup is getting serious about selling off some of its assets. That's where we begin tonight's market focus. The company has reportedly hired Goldman Sachs to look at its options. The sale of some units would help pay down debt left in the wake of its $6 billion acquisition of the pretzel maker Snyder's-Lance. That story was first reported by CNBC. The stock hugged the flat line most of the day, rising 1 cent to 42.04. Google's CEO told employees that the company is not rushing to launch a search product for China. That was good news for Baidu, which is a prominent internet search firm in that country. And it gave the stock a lift, rising 2% to 222.67. Google's shares fell to 1,215.85.
Morgan Stanley is cutting its profit estimates for General Motors. The analyst there says that GM, relative to its peers, has the biggest exposure to China in terms of profitability and cash flow. The firm says that GM is also facing increased competition there. Stock rose along with the broader market, though, to close at 36.38. Meanwhile, Amazon is reportedly planning to take on TiVo. According to Bloomberg, the company is creating a new type of digital video recorder for the streaming era. That sent TiVo shares down 4% to 12.20. Shares of Amazon were off a fraction today to 1882.22.
It is time now for our weekly market monitor. The last time he was on in November of 2017, he picked Cisco, which is up 26%, Vanguard Dividend Appreciation ETF up 10%, and Fidelity MSCI Healthcare ETF, which is 14% higher. Jim Lowell rejoins us. He is the Chief Investment Officer at Advisor Investments. Welcome back, Jim, and congratulations on those picks.
Well, thank you very much. Good to be back.
You have a little bit of a defensive strategy, not outward, but you're saying that basically we're a little long in the tooth and you never know what's going to happen. So you've picked a few stocks that might shield our investors, right?
That's right. I characterize it as defensive growth. Look, the fundamentals are strong. Earnings, interest rates, economic data suggests slow growth, not no growth, is the road we're on. But we know that this midterm election coming up is going to be vitriolic at best. And we think that the chance for negative momentum, a mood shift in the market is there. So defensive growth makes sense. Vanguard Dividend Appreciation.
That's your first pick?
Is my first pick. It's an ETF that basically has battleship balance sheet, blue chip names, companies that have consecutively raised their dividends over the past 10 years or more. So they have cash in the coffers, solid management, good low risk profile. I also continue to like Fidelity's MSCI Healthcare ETF, a broad swath of everything from major pharmas to HMOs to medical equipment and systems, as well as biotechnology. Healthcare's low risk, high return relative to the overall growth stock group makes it a good defensive growth play. And then on the bond side of the fence, I think hopefully everybody is relatively short in the investment grade duration space. But something to complement that could be Van Eck's Fawn Angels high yield ETF. It looks at high yield bonds that were formerly investment grade bonds that fell off that wagon but have a chance of climbing back up. The risk return profile there, again, especially in a slow growth as opposed to a no growth economy, looks like it's worth the reward. That is currently yielding north of 5.5%.
Always a great bow tie there, too, by the way, Jim.
Thanks, Bill.
Do you have a timeline for this? I mean, you're clearly becoming defensive. You're looking at slow growth, but how much time are you giving yourself to see this slow growth play out?
So we're definitely going to look at what happens not just up to, but through the midterm elections in terms of how it could impact policies that have clearly been creating uncertainty for not just the domestic, but the global markets as a whole. For example, Bill, we just pulled out of the emerging markets pretty much lock, stock, and barrel, assuming that that is going to be an area that really will continue to be under the gun of tariff and trade war concerns. So unless we get clarity there, we'll continue to be shy of the emerging markets and definitely ramp up our defense here in the U.S.
A quick question. Literally, the name of one of your picks was the Van Eck Vector's Fallen Angel High Yield Bond ETF. What is a fallen angel?
A fallen angel is formerly an investment-grade bond fund that has fallen down into junk bond status. And those bonds have a profile that has delivered a slightly better risk-return ratio relative to just the broad junk bond or high-yield space. So we like it as a good complement to a well-diversified junk bond ETF like the HYG. But we think that for investors who are looking for some way to add a slight increase in yield with a different kind of play, that would be the ETF to pick.
Jim, thank you.
Thanks, Jim.
Jim Lowell with Advisor Investments.
Back to school means back to the pharmacist for those parents of children who suffer from life-threatening allergies. But this year, there's a shortage of a key medication, EpiPens. Meg Terrell has more.
Alyssa Wackler's 6-year-old son Hudson has a severe nut allergy, and as he heads back to school, she needs to stock up on EpiPens.
I went to the same local CVS pharmacy that I always do to fill my son's prescription, and this year I was told that the EpiPen generic, which is what my insurance covers, was out of stock.
Wackler is not alone. Manufacturing disruptions for the life-saving allergy drug have resulted in pharmacies around the country running low on supply.
In my busy pediatric clinic, we have noticed that there are a number of patients, for example, calling in, wondering where they can procure their EpiPens.
Calls to 2 pharmacies from Boston to San Francisco revealed that almost every single one had no EpiPens or just a few in stock.
Wackler says she called more than 8 local pharmacies before she found one with one set that her insurance will cover.
I said, put it on hold, I will be there in the morning, and I rushed over and I got their last box.
Mylan, which sells the EpiPen, says it's exploring options with its manufacturing partner Pfizer to stabilize supply. Pfizer says it's experiencing delayed shipments due to process changes and cited supply of third-party components in the manufacturing process. EpiPen isn't the only option on the market. There's also the Adrenaclick and the AviQ, but it's by far the most dominant.
The school prefers the EpiPen because that's what they have trained their staff in how to administer.
Just this week, the FDA approved the first generic competitor to the EpiPen, while Mylan introduced its own authorized generic in response to an outcry over the EpiPen's price at the end of 2016. This is the first directly substitutable product sold by another company. That company, Teva Pharmaceuticals, said it's applying its full resources to the launch in the coming months. But that may not be soon enough to help parents like Alyssa Wackler get ready for back to school.
Love you. Have a great day.
And as Hudson prepares to start first grade, his EpiPen is one of his most important school supplies. For Nightly Business Report, I'm Meg Terrell.
And to read more about the EpiPen shortage, you can head to our website at nbr.com.
Coming up, the new status symbol on American highways. Are you ready for the $50,000 pickup truck? That's right. A new report says the average price for a pickup will soon cross that level, a sticker price typically associated with luxury models. Phil LeBeau has the details.
If this is your image of a pickup truck, beaten up, looking like an old dog, think again. Today's pickups are often shiny testaments to driving in luxury, with refined interiors and the latest tech features. That's why the average price for the 3 most popular pickups is now well over $40,000. And according to the auto website Edmunds, Those buying the new Chevy Silverado will likely pay more than $50,000.
For pickup trucks to hit that mark, it really shows how far they've come. The transaction prices have grown by almost 48% in just 1 decade.
Why are full-size pickups coming with supersized prices? First, the big three keep raising the bar. So as soon as Ford's latest F-Series rolls off the line with new capabilities and features, designers and engineers are working to make the next Ram 1500 just as capable, and where possible, adding on even more features. That's pushing up prices. At the same time, new full-size trucks have become status symbols, especially in suburban America, where pickups are often replacing high-end SUVs.
So these are really well-appointed vehicles that come with not only status, but also all the creature comforts that would come with an SUV. And the only thing they're generally missing is that third row, which a lot of folks aren't really looking for.
While Americans are paying more than ever for a full-size pickup, it has not cut into their desire to buy a truck. In fact, this year, full-size pickup sales are up almost 2%, outpacing the auto market as a whole. Phil LeBeau, Nightly Business Report, Chicago.
And before we go, one final look at the day on Wall Street. Late day rally with hopes for the U.S.-China trade talks pushed the Dow up 110 points. The NASDAQ and the S&P both rose by 9 points today. And for the week, the major averages were mixed.
That will do it for us tonight. I'm Sue Herrera. Thanks for joining us. Have a great vacation.
I'm going to try my best.
I know you will.
I'm Bill Griffith. Have a wonderful weekend, though. She'll see you on Monday.
Right here.